Hello, welcome everyone to the Story Trading Weekly Meetup. It's August 29th, 2021. We got two guests tonight, Michael Cook making his inaugural presentation to the community. Very excited about it. And Aaron Warwick, who's been here many times, who's presenting a stock as well. Just a reminder, Story Trading is not an investment advisor. Investing in securities involves significant risk of loss. This recording will be made available to our VIP members, and parts of it or possibly in whole will show up on the social media in the future. What's in a story trade? Story trading is the art of understanding market pricing through the lens of the four pillars of fundamentals, catalyst, sentiment, and technicals. We have an upcoming app, which will be the place to discover, collaborate, and validate market moving information through crowdsourced research and social collaboration. If you haven't already done so, please go to storytrading.com to sign up for our private beta release, which is coming soon. Picks that are presented on Zoom, our weekly meetups, are going to be tracked. We're going to track the performance as VIP picks. So it's going to be on an embargo, this information, for about a week. So next week, we're going to post these two stocks to our spreadsheet so the rest of the world can track how we do. And Warwick is back over here. 1 second.
Sorry for the delay, Aaron.
All right, no problem. We're good. Let me find Aaron. There he is. So let me just make Aaron co-host. Okay, so Aaron, welcome. Aaron's going to be presenting. Hi. How you doing? InfuSystem Holdings, ticker INFU, last trade 1423, market cap 293 million. The goal at Story Trading is to understand the story behind the trade. So I'm sure he's going to tell us a lot about fundamentals tonight. And we can maybe put the pieces together or understand what happened in the past year, which will help us anticipate and react better to future catalysts that are coming up. I do want to point out, there's one thing in the chart here that I know about. That was the COVID lows, and Aaron contacted me on March 16th, like literally at the low at like, I don't know, $5 or whatever. And he was very excited. He was trying to sell me on InfuSystem here at like $5-6, and I listened to him. And I don't know if I bought a small amount and sold it in a couple of days. But back then, I was totally focused on COVID stocks, and I'm sure Aaron remembers. I'm like, do they make money from COVID? Are they going to get hurt by COVID? I was like totally had this narrow lens about COVID, and Aaron was able to see past that, so that was amazing. Good job on that call, Aaron. So that's the chart, and let me stop my share. Aaron, you can take it from here.
Yeah, I think, Ben, you wanted me to make a disclosure at the beginning, correct?
If you have a disclosure to make, yeah.
Yeah, I mean, besides the fact that I'm long InfuSystem, I have a close working relationship with the chairman of the board, Scott Shuda. And of course, that he never shares anything with me that's inappropriate as it relates to InfuSystem. But Ben just wanted to make sure I make that disclosure. So anyhow, that I actually met Scott back in 2019, December 2019, at the LD Micro conference. So that's when I first started following InfuSystem. I think it was about $9 a share, right around there when I bought it. As Ben said, they really dropped big time at COVID. I mean, everything did, pretty much everything did it. And when COVID hit, down to the $6 level, and I realized it wasn't going to have much of an impact on them, certainly not much of a negative impact. It ended up having probably a neutral impact. We'll talk about that in a minute. And then shares have been as high as $22 not long ago, but they've since pulled back. And I think now is an opportunity. Really, what I'm loaded up on it. You guys know, a lot of you guys know I'm long on Quipt, and now InfuSystem has become, after this recent drop, which I'll talk about, has become my second largest position. I'm overweight on it now, meaning that I have it as more than 10% of my portfolio. Just to give you a brief background on InfuSystem, they have two different business platforms. Right now, the first one, integrated therapy services, represents about 2/3 of their revenue. And what that is, they facilitate outpatient care for patients requiring therapy using durable medical equipment, DME. And this is an area where InfuSystem is really going to expand. The margins are a lot higher there than their other platform, which is DME itself, which is just the rental or the leasing of durable medical equipment. They also are able to fix equipment. So if someone sends it back or they can buy it on the cheap broken, they can fix it in-house. They're actually probably one of the best, if not the best in the industry at doing that, and they can send it back out to sell or to lease and make money that way. And so that's about 1/3 of the business. The side of the business, though, that's really going to be growing is integrated therapy services. And it also has high margin, although the DME side, we're going to be seeing some changes in that side of the business, it sounds like, from their last conference call. Okay, so again, InfuSystem had recently been at $22 a share. They're now, as Ben said, $14.23. They closed out on Friday. So what happened? Well, pretty simply, what happened is InfuSystem had gotten a reputation of consistently beating and raising. So beating the analyst estimates, beating their own guidance that they put out, and then raising the guidance. Let's see, it must have been back in May. They had a conference call for the first quarter earnings. And for the first time, they didn't raise guidance, but they said they probably would raise it on the second quarter call. So here in August, on the second quarter call, the expectation was that the company was going to be raising guidance. Long story short, they didn't. And in fact, they actually said they're probably going to come at the low end of their previously stated guidance. Well, that happened for a couple of different reasons that I want to highlight, because all of them are pretty insignificant in the grand scheme of things, except for the fact that it actually signals what InfuSystem is going to be doing in the future. Okay, so the first thing, we talked about COVID earlier. So InfuSystem actually benefited from COVID on the DME side. It did hurt their integrated therapy services, but it did help on the DME side because there was a new partner actually they have in integrated therapy services that needed some DME, and InfuSystem was there to step up for that. So they rented this equipment out. It was quite a boon for them on the DME side in 2020. They expected that was going to continue through a good part of 2021, but that just didn't happen. It's hard for us to remember now because we're in this, this Delta surge. But, back in like March, April, people started getting vaccinated and the rates were going down. Everybody said, okay, this is over. And very quickly, the company started returning to them these DME rentals. And so this was a hit of about $3 to $4 million through the annual revenue. To keep that in perspective, they're about a $100 million company. So you're talking a 3-4% hit. Actually, I think their guidance this year is 107 to 110. They said they're going to come in at 107. So you can see just by the quick return of that equipment that already, put them behind for their guidance. They came in now at this quarter saying we're going to hit 107, probably the lower end of the previous guidance. Well, if you add 3 to 4 million, you can see why they thought they were going to be raising in the second quarter earnings call. So that's one reason. The second reason is they have a new opportunity on the DME side to basically repurpose some equipment. And they just made some acquisitions earlier this year. They acquired Philomed and OB Healthcare, and they're going to be repositioning this DME unit to go into biomedical services and partnerships, if I understand it correctly, with hospitals. So this was another $2 to $3 million hit because they had to repurpose this equipment. And so instead of sending it out like they normally would, making the sales right away, they're getting this equipment ready for the biomedical services, which is going to be a lot higher margin. I haven't verified with the company, but my guess is the DME side, I think, is around 35-40% gross margin. My guess is in the biomedical services, you're going to see at least 50%, if not up into the 60% range for the gross margin. So this was a really, I believe, smart move strategically. We'll talk about this a little bit more in a minute. And then the final thing that hurt them in the short term on the quarterly results, and then how they felt comfortable on the guidance, is they made an investment in human resources and specifically in salespeople. And they did this in two areas. They had some people that came to them for pain management in their ITS, integrated therapy services side of things, who they consider to be all-stars. And basically what these salespeople saw that InfuSystem is going to be doing well. So they approached InfuSystem, and InfuSystem said, hey, these are good people, we got to bring them on. Similar thing happened in wound care, which is the longer term for that is negative pressure wound therapy. We'll just call it wound care to be simple. There was a shakeup in the industry. I can't remember now who the company was. But anyhow, there was a company that got acquired by an enormous company who immediately laid off a bunch of the sales force, trying to cut costs. And these people were available to InfuSystem, and the assumption I kind of hear, talk to people familiar with it is, and you can just assume these salespeople have a lot of relationships already. I mean, they were at the leader for this wound care therapy services, and now they're at InfuSystem. Well, this costs them, between the pain representatives, salespeople, and the wound care, I think it was like $2 million, 2% drag on their EBITDA margins in 2021, which would translate to roughly $2 million. So this is why they missed both their guidance that we expected going into the call, is the DME side of things, why they missed their guidance, and then the margin numbers are going to be worse in 2021 because of hiring these people. Now, just to give you some perspective, at a minimum, from the time that you hire a salesperson in this industry, they go out and make the sale. Patients start using the equipment. You bill for the equipment, you get the reimbursement, and you're able to record revenue. You're talking at least 6 months, if not 9 months. So basically what's happening is InfuSystem is having to take this hit in 2021, but it's going to benefit them in 2022, 2023, and beyond. And that's what I want to get into now. So how much of a benefit are we talking? Again, keep in mind, right now, InfuSystem is 107 to 110 million projected for this year in revenue. So keep this number in mind. And I guess I'll just skip ahead to tell you. So when you get done with these calculations, and I'll walk you through them, but when you get done with these calculations, I think in probably 3 years, this company that now is 107 to 110 million revenue is going to be producing probably 80 million in EBITDA. So that's how significant this situation is, and why InfuSystem says, hey, we'll miss our guidance. We got to make this investment now. As the CEO said, I'd make on the conference call, I'll make this investment 10 times out of 10, every time it comes to me. So there's 4 new areas. Number one, they're going to be entering lymphedema. Lymphedema is the biggest TAM that they have of any therapy they're going to be offering. It has a total addressable market of $1.5 billion. My expectation, based upon what I've heard from the CEO talking about it, is that they could probably get 10 to 20% of that market. So you're talking 150 to 300 million dollars that they think that they can get over, this is like 5 years we're talking about. So, don't think this is not 2022. The second one I kind of alluded to earlier, biomedical services. This one, they haven't really given out specific guidance about the TAM, other than to say it's probably the second highest TAM of the 4 new therapies that they're going into. My guess is it's going to be about similar to wound care, so probably about 60 million. Again, we're looking at 3 to 5 years, but they did say with the biomedical services, 2 things that are important. Number one, it's going to be ramping up the fastest. And number 2 is that they should have something that they're able to communicate to the market about what's going on there soon. That's what they said on the conference call. We actually had someone that's on StockTwits as well, but one of our research partners found I think it was the 26th of August, InfuSystem requested a trademark for a logo and a name device hub. And from looking at that filing, it looks to me like it probably is related to this biomedical services, and would look to me like, they're making some significant progress in this area. My guess, based on what they said on the call and what I know about this, what they're doing there is that they're probably going to have a partnership of some kind with the hospital coming in the not too distant future, based on all of these data points. Wound care is, again, probably about a 60 million, and we're talking annual numbers here. So 60 million, they think they can get 10% to 20% of the TAM there, which is $600 million. So, I think it's quite conceivable they'll get to 60 million. And then the final one, pain management, is probably the smaller, but again, should be ramping up a little more quickly because they did hire these reps that came to them. And so thinking 10 to $20 million annually on that. So when you add this all up, what I'm getting at here is, or what I'm using here is a 12 times enterprise value over EBITDA multiple. Definitely a person can make an argument that's fair. I think for a company that's got the organic growth that InfuSystem has, once the market sees that, it's probably going to be a higher multiple, but I'm just using that to be conservative. So when you add all of this up, and by the way, oncology is about $60 million for them right now. That's the integrated therapy services. That's the highest revenue generator for them, and is pretty well established. They said it'll probably grow about 5% per year from here on out. So no huge growth there. So I'm assuming about 5% annual growth in the $60 million oncology business. You got $40 million annual. I'm talking here about 3 years from now, by the way. So 40 million annually in biomedical services. There possibly some upside to that, because again, it could be their quickest therapy. Wound care, which again, they've set this target of 10 to 20% of the market. So we think they get up to 60 million eventually, at least. I'm saying in 3 years, they'll get to 40 million. That one's going to take a little longer. They've said to get up to speed. Pain management, again, should be pretty quick. So I'm going in between 10 to 20. I'm saying 15 million in annual revenue. And then lymphedema, kind of a wild card. Okay. Huge TAM, 1.5 billion. And I'm assuming that in 3 years that they can get up to 150 million in revenue there, the lower side of their target. By the time 5 to 7 years, I think it could be up to 300 million. So in 3 years, it'll still have some growth behind it. Final thing to mention is, I think their EBITDA margins, they're targeting 30% long term. I think they can get beyond that, but right now that's what's out there as the target for the EBITDA margin. So you factor all this stuff in, and what I'm showing them at 3 years is $265 million in annual revenue. And again, as I said, EBITDA about $80 million annually for a company that right now has $110 million in revenue, $107 million estimated this year in revenue. And the gist of it is, using the 12 times EV over EBITDA multiple, you're looking at about 175% higher from today's, not from today, but from Friday's closing price. And of course, I think my multiple's fairly conservative. I think there's some upside in the business besides the estimates that I make. And I think, that I do think this EV over EBITDA multiple will expand. Most likely they're trading at about 12 times now. I think it will expand once the market starts to see them making some progress. And I think you're also seeing a rotation now of the shareholder base, because, at a couple of weeks ago, InfuSystem was a solid, steady company that always would beat and raise. Now, they missed. They said, we're taking a little bit of a pause for, the rest of 2021, we're not going to hit the numbers that you probably thought we were, but we're going to be growing way more rapidly than we could have ever imagined. So I think you're kind of getting a turnover. There's a lot of institutions, a lot of investors that want to just get in and ride the gravy train, and so they're going to miss like our groups, that StoryTrading and other groups out there that a lot of people participate in. I think we're looking for something, before the market understands what's going on there, before investors and taking a bet, that the company's going to actually do what they're set up to do. A lot of investors, a lot of institutions, I can't blame them. They probably make good returns too. They're going to wait and see. And then when they see that it's happening, then they're going to get in and ride that train. In terms of risks, one thing I want to throw out before Q&A, I think the biggest, honestly, before this change, I thought there was pretty much zero risk with InfuSystem, what they were doing. They have a proven model. They've been around for 34 years. The CEO has worked his way up through the ranks. It was really like riding a gravy train. So the biggest risk now is, can the organization handle this rapid growth? I think they can. And the reason is most of what they're doing, actually all of what they're doing is just relying on the infrastructure that they built for their oncology integrated therapy services business. Sure, you're going to have to hire people. You're going to have to hire some salespeople. You're going to have to hire some more billing people. You're going to have to hire some nurses, more nurses to answer the phone. Okay, but these are all like pretty simple things to do. They're not, even though they're pivoting, they're not like reinventing the wheel. They just had these opportunities that came to them really because of what they've been doing in oncology, what they started to do in pain management, what they were getting ready to do in wound care with their partner Cardinal Health, a huge organization.
I used to work for Cardinal Health.
Oh, did you really?
Yeah,
okay.
For 2 years.
So nothing is really changing. Like, it's not a change in what the organization does. It's just expanding it. But, it's still risk. It's still a risk. So that's all I have for now, but I'm happy to take any questions.
All right, great. Thank you, Aaron, for that presentation. I have one question and then we're behind time, so maybe we'll take one or two if there are. But my one question is, are there channel checks that can be done here to get an early look at performance before it's reported on the street?
It's possible there could be. I'd have to beat around the bush and figure out, where people in our group, how they could do that. It's not something that, you'd have to be kind of located somewhere, but I just don't know how I would go about it right now. I haven't really given that much thought. I've just come to trust the company. The CEO and the CFO are real solid. You go back and look at their calls; they're very straightforward. And up until recently, they I don't hold this against them, but they've always hit their numbers. They've always hit what they're saying they're going to do. I'm not going to blame the company for pivoting because of a massive opportunity in front of them. I think a very smart move. And I've been trying to add a little bit every day. If people are going to bid it down or sell it down, I'm just going to keep adding because, eventually I think that people are going to figure out what's going on. We're going to get a solid shareholder base in here and we're going to start seeing the results.
Okay, perfect. So I don't see any other questions pending. So Aaron, we've opened up the INFU research group. You're welcome to join us there. The link is in the chat. And we look forward to further collaboration on that. Thank you again, Aaron.
Thank you, guys.
Yep. All right, guys, coming up, VIP events actually next week. This is the first time we have a clean slate. We've done a tremendous amount of events in the past month. This Wednesday, we can actually have a happy hour again. Next week, I believe, is Labor Day weekend. And in fact, next week, Sunday and Wednesday, I will not be able to attend for some personal time off. Normally, I guess we would do it on a Monday night since the markets close Monday, but I will not be available Monday or Wednesday next week. The link for happy hour next week will still work. So anyone who wants to join then can do that. So also you can follow us. Please do so at YouTube and and Twitter on StoryTrading.